We work hard and save our money for the day we can retire and spend some quality time with our families, but how protected are our savings, and is it possible that fees are chipping away at them? That's exactly what we're discussing today with Michael Canet, the Savvy Investor. Michael, welcome back, sir.
Good morning.
Let's talk about these fees. I mean, they can really cut into that nest egg. Talk about them.
Well, there's several different fees that you need to be concerned about. You know, obviously one of the things that we always look at is how the advisor gets paid. That's something you need to consider. What the investment vehicles themselves cost, but also whether you're buying an investment vehicle that charges a commission. And there's nothing wrong. People often get nervous about the idea of paying a commission. There's nothing wrong with that as long as you know you're paying a commission. But you want to ask those questions because you need to know how much is it going to cost you to be in your investments, especially towards retirement.
And it's interesting to note that different investments have different levels of fees. I mean, what are some of the ranges you've seen here?
Well, I've seen fees everywhere from like 0.5% all the way up to 5 to 6%. You know, so if you think about a mutual fund, you know, that's something that people frequently invest in. And one of the problems I have with mutual funds is that if you think about it, it's a big basket of stocks and bonds, right? And every time you put money into it, there's a transaction cost involved because the manager has to buy more stocks and bonds. And every time he sells, there's a transaction cost. And then you're paying the manager some fee. And it turns out about 70% of all these active managers of mutual funds, they underperform. And so you're paying them 1% to manage the fund. You're paying maybe another 1 to 2% transaction costs that you're not even aware of. And then if you've ever seen, I don't know, one of those little green arrows that lead you to retirement, or the talking origami orange bunny at dinner time, right? Maybe too much wine. But those things are called 12B1 fees. So at the end of the day, mutual funds typically are costing you 1 to 3% to own. And an annuity, I mean, that's the big thing that Ken Fisher has a problem with, 3 to 7% to own an annuity. So they can be very, very expensive, and those fees do add up after time.
Absolutely. You were talking about that range of percentiles, 1 to 3%, and just the difference between, say, 2 and 3% or 6 and 7%. 1% can make a huge difference in what you end up with.
Absolutely, absolutely. I mean, if you think about it, you're paying your advisor a fee, you have that fee of the investment vehicle, but then when it comes down to the actual investments themselves and how they do over time, you know, if you put $100,000 into the stock market and you're getting a 6% return, you have about $320,000 over a 20-year period. But 1% more, so your fees are just 1% less, all of a sudden you're at 386. I mean, you're talking 20% more money during retirement. That's a huge number. I mean, it's a huge number to go through retirement with that.
Another $65,000 for 1% difference in your fee level.
And that's just shopping around. That's just asking the questions. You know, when you sit down with an advisor, it's perfectly acceptable to say, how do you get paid? You want to know that. You want to know what are the underlying investment fees? Are there transaction costs? You need to know all that, and you should ask.
Absolutely. Any other thoughts on just the spread of retirement investments and the fee levels? Any parting thoughts on that?
Well, so I think that everybody should look for index funds. If they're going to be actively in the stock market, we think index funds are the place to go. ETFs, if you're a mutual fund fan, I would lean towards Vanguard. Look at those type of funds because they typically have the lowest fees for the investor. And when you're working with an advisor, talk to them about how they're getting compensated. And, you know, 1% for an advisory fee, that's probably in the reasonable range. But that's what you need to know, because for you to have the successful retirement you want, to have the money and the income that you need during retirement, you want to keep those fees to the minimum.
A good advisor can help you select some of those lower fee investments, and it saves you over time. Well, Michael, thank you so much for being here and talking a little bit about those all-important fees. I think we've all learned today. By the way, if you'd like a complimentary risk and fee analysis, first 10 callers can get that, 866-597-1040. That'll get you in touch with Michael Canet and the Savvy Investor. Coming up, a new restaurant in Baltimore serving up some modern soul food. You'll want to stay with us.